from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, what goes down comes back up. Stocks storm back from a 4% plunge, closing higher on the day. We'll tell you how tech is making out. Plus, Bitcoin bounced. The cryptocurrency climbed into positive territory for the first time in a week. Could this signal the beginning of the end of the crypto crash? And the 19-year-old who hacked 24 Teslas, David Colombo, joins us exclusively this hour. We'll get to all of that in a moment, but first let's get a look at the markets and our Ed Ludlow. Ed, we got earnings and a big name in tech, aka Big Blue, after the bell.
Yeah. Well, first, let's talk about IBM, right? 110-year-old company. We don't often focus in on them, but stock up almost 6% in after hours. Strong numbers in the fourth quarter. Sales up 6.5% to almost $17 billion. Lots of strength in their cloud unit. In fact, this is the best sales growth that IBM has seen in a decade, pretty much. So one to look for over the next 24 hours or so. This just adds to the excitement of what was a wild day in the markets. Let's look at where we ended. As you say, we see really heavy selling in the morning across equity markets, mostly in technology shares, and then look at the Nasdaq 100, closing up 0.5%. The NYSE Fang Plus Index is a good point, though, down 0.9%, almost 1%, because some of the mega caps did continue to be under pressure. The likes of Tesla, Apple, Netflix all closed lower. And Bitcoin is the most interesting of the case studies, because when we saw that rebound across risk assets, it was Bitcoin that moved first. Remember, Bitcoin trades 24/7, right? So we're seeing it hover around $36,700 per token on your screen. And the Bloomberg Galaxy Crypto Index is giving us a reading of -8%, but that's from Friday's close because the index doesn't trade over the weekend. But as you say, could this be end of the route? A picture tells 1,000 words, right? Bring up the next chart and let's look at the Nasdaq 100. We go from a 4.5% drop, by my little hand there, to a 0.5% gain. What's on the top of mind of investors? Was this dip buyers? Are they getting more sanguine about rising rates in the Fed? Impossible to know. If there was an area of the market that didn't escape the pain, it was the meme stocks. Look at these two old favorites of ours, Emily. AMC and GameStop, both seeing heavy losses. In fact, the meme stock index, which is a custom basket that Bloomberg tracks, is down 60% over the last 2 months. So clearly investors kind of being a little cautious in this area. And finally, Em, what were you doing in 1994?
I think I was maybe just a little bit older than you.
Yeah.
Just a little.
Well, let's not go there, okay? I was probably still in nursery in diapers in 1994, whatever. But it's interesting because the Philadelphia Semiconductor Index, the SOX, also rebounded on Monday. And good, because it was having its worst start to the year since 1994. The first 24 days of the month of January going from December 31st to present day, it's the worst performance we've seen since this index began. But again, take the bigger picture here. Look at the performance of this index through 2015 onwards and the gains it's seen in the context of that chip crunch. Really one to watch going forward.
All right, Ed, thanks much. I want to stick with today's tech market moves and bring in Creative Strategies Principal Analyst and CEO Ben Beharan. Ben, great to have you back with us. How are you making sense of all these big tech moves, big plunges, comebacks? What does it mean?
Yeah, I think overall, my sense, and I heard some chatter that this was a dip, and people were seeming pretty optimistic that they would buy on the dip. I think the question was really how low some of those stocks would go. You know, overall, we're just continuing to see so much demand for a number of technology stocks that it seemed hard to read this as a giant market correction or that so many stocks were just really overvalued. I mean, I think you've got some stocks that were, inflated via the pandemic that might see correction, but I think there's a lot of good fundamentals still at play. And I think, again, IBM's earnings and a range of others will prove that out, that there's still just a lot of demand for tech.
What about some of the not so great stories? Netflix, for example, a huge plunge. Could it be the end of the beginning?
Yeah, I think, again, if you look at things like Netflix, I think you might be able to throw Peloton into that. You're hearing a lot of chatter again about there being optimism that maybe we're at the end of COVID, or that the pandemic might be opening up new opportunities for people to go out and about again, whether it's travel or whatnot. And so obviously they're not going to have as much time to consume these goods and services. So I think there's a little bit of concern about things. Netflix could play into that. You're seeing that with Disney. Obviously, Peloton's falling into that. And so there is the matter of competition for time. And if we're not going to be at home as much, I think there are some stocks that will suffer for that. But I don't think that's a signal of the overall market, where I still think you'll see a lot of really positive earnings come from tech this week and next.
Where are you looking to see positive stories, and where are you looking to see some negative stories?
Yeah, I think the positives, I think the best way to look at the market right now is in terms of infrastructure. I think we're still at a point where digital transformation has not really come to and eaten every industry that's there. So there's a lot of headroom for tech. So again, cloud stocks, data center, infrastructure, semiconductors, I think will continue to do really well. We're still seeing so much demand for those stocks. So I would look for those things if you're looking for safer bets, that you consider infrastructure stocks. So Amazon's in there, Microsoft, Google, Qualcomm, NVIDIA, AMD. I think a number of those will play out really well just because, again, they're feeding so much of the infrastructure. So those, I think, will continue to have those signals. What you said about like Netflix and some of those others, maybe some pure hardware stocks where we might see some prices fluctuate, could be a little bit more of a concern. But I'm really fond of the infrastructure side because I still think there's so much tech build up that's going to happen as digital transformation expands.
We've got Apple coming up this week, Facebook, Google next week, and some other big names. Any specific storylines you'd pull out, given Apple is a hardware company, yes, also a software company?
Yeah, I think Apple, again, the product story remains strong. I still think there's a lot of optimism for them. They're a hardware, software, and services company, so I think there's a lot of wheels feeding into their overall business. Facebook, again, right? We're coming off watching them from multiple of quarters and what's going on with advertising, and obviously, now they're going to be talking more about the metaverse, what that looks like for Oculus and platforms and beyond. So I think there's still some questions for them and a few others as we move back into more normalcy with tech, and again, people spending their time perhaps other places, not just sitting at home, spending more time on their devices. So there's a risk for those types of stocks. But yeah, I think that you're going to see Apple will do fine from an earnings standpoint. But I think that the easiest things to keep a look at is those that are infrastructure stocks, because those have the most headroom to continue to supply the backbone of digital transformation.
So what would your advice to investors be right now, given how many jitters we've seen to the start of the year and the fact that tech, for years leading up to this, has been a safe bet, a haven?
Yeah, I think there's still a lot of safety in a number of good stocks. Just, again, just because there is so much opportunity now for tech to go into areas. We talked about this last time, I'm still really bullish on semiconductors. They're going to move into, as a core part of digital transformation, you've got retail, you've got healthcare, you've got automotive, all of these areas that are still vastly untapped from a semiconductor standpoint, which again, I bucket those as infrastructure. You're looking at what's going out with wireless, with 5G. And so Qualcomm is well positioned there as they're now starting to take advantage of, again, retail, IoT, automotive. So obviously NVIDIA is there as well, talking up just what's going on in cloud and AI and training for back-end data centers. So I think there's, again, really safe bets. This is defensible by, if you just look at where software is going, CIO budget spends coming back to hybrid cloud and the back end. It just seems to be that these are defensible budgets that will continue to grow. The consumer side, I think, is where there's a little bit more questions, again, coming out of the pandemic, with inflation coming, where they'll spend their time and their money. I'm still optimistic on a number of those stocks, but I think we need a little bit more time before we buy in and say, okay, these are going to continue to ride on an upward path.
All right, Ben Baharin, Creative Strategies. Always appreciate your insights here. Thanks so much for joining us. Lots to look ahead to. Meantime, a group of attorneys general from Texas, Indiana, and Washington, D.C. are suing Google, claiming the company uses deceptive tactics designed to trick consumers into disclosing location data to more accurately target advertising. The lawsuits allege that even when consumers turn off location tracking on their phones, Google continues to track their movements using a separate function called Web and App Activity. A similar case was filed against Google by the state of Arizona in 2020, and that case is still ongoing. Coming up, we'll have more on the big crypto sell-off and its early signs of a comeback. We'll talk about that and more with Blockchain Capital's Spencer Bogart. That is next. This is Bloomberg. Bitcoin hovering dangerously low. Bitcoin snapping a 5-day slide as a late rally in U.S. equities suggested investors are retaining some degree of risk appetite. Bitcoin back up now to about $37,000 after hitting a low of just below $33,000 earlier, the least since July. I want to get into it all with Spencer Bogart, general partner at Blockchain Capital. Spencer, what do you think is driving the declines and also maybe this, modest recovery today?
Sure. I mean, look, fundamentally, I think that this is a macro-driven sell-off. I mean, when we look under the hood here, I think that this recent pullback undervalues the progress, the traction, and the opportunity size of everything that's happening in crypto. Is that part of maybe the little bit of a late surge later in the trading session? Maybe. It's really a long-term kind of sector, not short-term here.
Okay, so let's talk about short term, though, because that's what investors are really concerned about, especially if they're thinking about pulling out now. Do you see these losses, this crash, this winter, if you will, extending for a significant period of time? Or, within a short term period, do you see more upside?
Look, we think about upside in terms of basically 5 to 10 years. So what's going to happen in the next year or two remains to be seen. I mean, plain and simple, let's zoom out here. Crypto is both disrupting and creating new opportunities in multiple trillion-dollar markets. I mean, let's talk about just finance, gaming, and social. That's just 3. So that stuff's not going to go away. The traction is very real. We're seeing progress on all of those fronts. But the backdrop here is really the pace of innovation. So when you're thinking about from a forward-looking perspective, what's exciting about what's happening here? And it's really all about the pace of innovation. I think in the history of technology, we've never seen anything match this pace of what we're seeing in crypto today.
I asked MicroStrategy's Michael Saylor the very same question about how long he plans to hold his Bitcoin. Of course, MicroStrategy, the largest corporate holder of Bitcoin in the world. Does this signs of winter, the cold, give him any pause? Take a quick listen to what he had to say.
No, we're not sellers, right? We're only acquiring and holding Bitcoin. Right? That's our strategy. We've been very clear. We actually put it in black and white in our 10K. You can read it in our SEC filings.
That's in response to a question that was basically like, would you ever sell? And the answer was basically never. I mean, is that the right strategy?
Look, kudos to Michael for his strategy. He's running a very different type of investment strategy from what we're running as a venture firm, right? I mean, again, we're thinking about some of these fundamental backdrops. Right? We have this permissionless open infrastructure that anyone can build on. We have this open source technology, so new founders coming into the space don't need to recreate the wheel. Anyone can take these protocol applications off the shelf, add something to it, and create something entirely new. And we're running all of these experiments in parallel. And that's what's driving this pace of innovation that gets us really excited as venture investors. So is there any one asset that we hold in our portfolio that I'd say we would never sell? Of course not. That's not in our business model. But for Michael Saylor and MicroStrategy, they're running a different game, and that's okay.
So for those who aren't venture capitalists like yourself, but want to have some exposure to the market and don't know what to do right now, how are you looking at this crash? Is this similar to what happened in 2018? I mean, is it that dramatic? Is it something softer or different?
I don't think it's anywhere near the same situation of 2018. In 2018, we're coming off a backdrop of 2017's ICO phenomenon that had a lot of projects selling tokens up front for applications that were yet to be developed. Many of those never launched. Now, in contrast, what we're seeing here is live networks and live applications where you can review the data on chain on a real-time basis to see how they're performing. We can see how much fees they're generating on an hourly basis, on a minute-by-minute basis. And the numbers are pretty incredible. Several of these applications are generating well north of hundreds of millions of dollars a year annually in fees. So they're delivering real utility to their users. And that's very, very different than 2018. Now, the other thing I would add here is that the backdrop is very different. So in 2018, this was entirely a secular bull market, or a bear market, sorry, for crypto. Now, in contrast here, the secular story for crypto is all very, very bullish. We just have a negative macro backdrop.
After a big football weekend, got to ask you about the chatter about some of these major athletes accepting their paychecks in Bitcoin. Odell Beckham Jr., of course, here in San Francisco, Golden State Warriors, Klay Thompson, Andre Iguodala. Do you think this was the right play for them, pun intended, given that, they're losing money?
Look, I think that this kind of a strategy is really only suitable for those that can afford to have long-term commitment. And so fortunately, these kind of high-profile names, they're doing this in that category, and I think that that's okay. But I don't think it's suitable for the vast majority of people that don't have the kind of extra income to take that sort of risk. Now, of course, we should keep in mind that presumably all of those athletes, I don't know exactly what their contracts look like, but presumably it's a fixed in USD term and then converted into crypto. In which case, it's really just a way to average into the industry over time as a percentage of their paycheck. And that seems like a savvy play to me.
All right, well, we'll see if those quote-unquote savvy moves keep up, especially through some of this uncertainty. Spencer Bogart, general partner at Blockchain Capital, always great to have you. Thank you for stopping by. Coming up, the ride for Peloton CEO John Foley getting real bumpy as one investor, at least one, wants him ousted with shares tumbling. More on that scathing letter from Blackwell's Capital next. This is Bloomberg.
I think the word is out that Peloton has these experiences, like you just heard. The word of mouth is really helping us because people get addicted to them. They say, why would I go back to the gym? Why would I travel for an inferior experience? And that, you know, COVID or no COVID, that's a universal. So we believe that the growth we've seen is going to continue for years and years to come.
My conversation there with Peloton founder and CEO John Foley nearly a year ago. He was responding to my question about life after the pandemic and whether there will always be so much demand for Peloton. And well, here we are, demand for Peloton indeed falling. Now there's calls from at least one investor, Blackwell's Capital, to not only sell the company, but remove Foley. For more, I'm joined by Bloomberg's Mark Gurman. And Mark, I want to read you a quote from this letter from the chief investment officer at Blackwell's Capital saying, we believe that no board exercising reasonable judgment could leave Mr. Foley in charge of Peloton. The company has gotten too big, too complex, too damaged for Mr. Foley to lead it, and he should have enough self-awareness and enough self-interest to resign as a director. What's your take on this?
It's interesting because Peloton completely and utterly mismanaged their own success, mismanaged expectations, and mismanaged their entire supply chain, right? They invested millions and millions of dollars at the completely wrong time in additional supply. A year ago, they had an endless amount of demand and very little supply. Now they have an endless amount of supply and, you know, pretty much very little demand. It's a complete opposite situation in the demand-supply balance. So they're in big trouble. They are going to be eating costs. There's a reason why we have these plans and reports of production halts, right? They can't keep producing bikes if they're not selling at that same pace. That takes us back to the supply chain model of Apple and Dell back in the day and so many other consumer electronics makers where they really were building with just weeks of inventory, right? It's possible Peloton has, you know, a year of inventory for its supply right now with very little demand. And what happens when they need to release updated versions of the bikes and treadmills later this year or next year, right? So they're in a very bad position in terms of supply and demand balance. And this is why you're seeing stock reaction in these letters.
Give us a snapshot of what demand really looks like right now compared to where John Foley thought it would be a year ago when we talked.
Yeah, what Foley seemed to think, what Peloton seemed to think is no matter when the pandemic slows down, when people are able to go back to the gym, people are not going to want to go back to the gym. People are going to want to still work out from home because, as Foley said in your interview with him about a year ago, working out from home, in his opinion, is more convenient, it's less expensive, it's an overall better experience. Well, that was completely misjudged. What we're seeing people wanting to do is actually get out of the house and go to the gym because they have been locked up at home for the last 2, 3, and we're going in obviously year 3 of the pandemic now. So a complete misjudgment there. There were people who thought the end of, going out, the end of this, the end of that, right? And that Uber and Postmates and all these companies would take over the world. That doesn't really seem to be the case. It seems people really want to go out and about and go back to, pre-2020 days.
So how do you think Peloton emerges from this crisis? What happens?
I mean, this is a really, really bad situation, but I think the silver lining for Peloton right now is they're doing a very good job in terms of content and services and their subscription offering. Their churn rate is not as good as it was a year ago. I think it's about a 15-20% difference at this point, but still their content is very well received. Their ability to do marketing and social marketing and getting people locked into the ecosystem is very well received. So I would imagine we see a much stronger push towards the Peloton digital offerings, whether that's their apps on phones and tablets and TVs and other smart home appliances. It's pushing through the web, pushing through computers, more subscription-based things that don't require Peloton, bikes at home and this $2,000 to $3,000, $5,000 equipment in some cases. So I think it's more of that. The Peloton Guide, that's a $500 device where you hook it up to your TV, you have a smart camera, and it really understands your body. That's much less expensive. So I think what you're going to see in the future is Peloton doing more things, cheaper hardware, and a bigger push towards those subscription services that don't require, those pricey bikes.
Quickly, do you think Foley survives?
I do, right? I think that we've seen the control structure there. We've seen how the board is organized there. We've seen the voting rights and such. And I think it would be very hard to remove Foley. He would have to step down on his own. And I'm not entirely sure why he would do that. Remember, he's the person who built the company up to that peak. I'm sure he and the board believe he can do that again.
Okay. Lots to continue to follow. Our Mark Gurman, thank you for that update. A story we continue to watch. Tesla now runs the most productive auto factory in America. Last year, the Tesla plant in Fremont, California, produced an average of 8,550 cars a week. That is more than the Toyota factory in Kentucky, as well as the BMW plant in South Carolina, and Ford's truck plant in Michigan, according to Bloomberg analysis of more than 70 manufacturing facilities. CEO Elon Musk says he plans to increase production at both his California and Shanghai facilities by 50%. Well, the 19-year-old hacker who broke into 24 Teslas, coming up. We'll talk exclusively with David Colombo, who discovered a dangerous security flaw that enabled him to turn cars on and honk their horns remotely. That is Ness. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Earlier this month, a 19-year-old cybersecurity specialist in Germany stumbled upon a pretty big flaw involving Tesla. David Colombo discovered that thanks to some third-party software, he could not only access data on about 24 Teslas, but also take control over certain functions, open doors and windows, turn up the music, even honk the horn. He posted about the discovery on Twitter, which set off a firestorm online, and even tried to contact some owners to make them aware of this vulnerability. Joining us now exclusively is David Colombo, the hacker in question, also the CEO of Colombo Technology, and we're also joined by Bloomberg's Ed Ludlow, who covers cars for us as well. So, David, you could also start the car without the keys, figure out the car's location and whether a driver was inside or not. Talk to us about how you stumbled upon this flaw. How did you realize you could hack a Tesla?
Well, it's quite an interesting story, and it started last year, actually. So I was just, I was in the process of doing a security audit for a French company, and I just took a peek look at the infrastructure. I didn't even start a security audit yet, just wanted to take a quick look at the infrastructure to figure out what services they use. And I thought maybe I would find something really quick beforehand. And that's when I discovered the third-party software in question. And that's where I discovered that the third-party software in its default configuration is insecure and allows me, through a vulnerability, to get access to the API key of the person using the third-party software. And the API key, the Tesla API key, is like a digital car key, basically, that also allows for remote control functionality. You already mentioned opening windows and doors, unlocking the car, seeing where the car is, starting keyless driving. So someone with malicious intent even could have taken the car for a road trip, going there, turning off the security mode, unlocking the door, starting keyless driving, and taking the Tesla for a road trip. And yeah, so that was basically when I discovered this. And then on the 10th of January, a random thought crossed my mind, like, if the default configuration of this third-party software is insecure, what if there are more people out there using it? So I ran an internet-wide search for those instances, and I found numerous Teslas. And there were Teslas in California, in Germany, all around the world, in 13 countries, actually. And
Wow.
I really wanted to report this to the owners to get it fixed, because in my opinion, this is a huge issue if someone can take your car for a road trip.
Now, we have reached out to Tesla for comment, but haven't gotten anything publicly or heard from the company publicly. We do know that they have a bug bounty program. What kind of conversations have you had with Tesla? Have you spoken to Elon Musk?
I have not spoken to Elon Musk yet, but I have spoken to the awesome Tesla security team, because after my tweet, the Tesla security team reached out to me and I've gotten in contact with them. And they were very helpful. They understood the issue. I sent them my write-up privately so they can get an overview of the full situation. And they responded very quickly. They revoked access. They revoked the access tokens that were exposed to the internet. And they also notified the affected Tesla owners using email and push notification. So I'm very glad the Tesla security team helped here to notify all the affected owners to get this resolved as quick as possible.
Right. So Em points out, David, that, you know, Tesla haven't talked about your activities publicly. You're in touch with Tesla. We do know that Tesla has a policy, right, when it comes to the cybersecurity community. In fact, let's bring that up and take a look at it. Tesla basically saying that they work with the cybersecurity community, right? When a flaw is identified, when a flaw is brought to their attention, you know, we're committed to working with this community to verify, reproduce, respond to legitimate reported vulnerabilities. So talk to us about the kinds of communications you're having with Tesla. What is it that you're helping them with? And are they giving you any reward for flagging this to them?
So a very great question. So the process was pretty much, I sent them all the information and they started investigating this issue on their side to figure out how it affects this or how they can help the security researcher here. And then they very quickly responded saying they acknowledged the issue and then took action very quick. But I do not get a bounty from Tesla for this whole thing, because it is indeed a vulnerability in the third-party software and not directly in Tesla's code or the car software itself. But in the process, I also found another minor flaw affecting Tesla's API directly. I also disclosed this to Tesla, and this vulnerability, the minor second one I found, is indeed eligible for bounty, but I haven't got a response from Tesla yet how much the bounty will be. But I hope it pays for all the coffee from the last 2 weeks.
Okay, well, we hope that for you as well. Well, okay, so there's two separate things there. A fault in the API that you found yourself, but the original hijack, that was a third party, right? An issue or a flaw with a third party. Can you explain that distinction to us? Why it's you were really stressing this on Twitter, right? That this was something going through a third party, not Tesla's security infrastructure itself.
Exactly. So there's a very important difference between those, because one time Tesla, the company, is responsible. And with the third-party software, it is an open source software that is on GitHub, and it's maintained by cool people. And it's a difference if you find a vulnerability in a third-party software, an open source third-party software, than to find a vulnerability in Tesla's infrastructure directly. And unfortunately, a few media articles claim that I hacked Tesla directly, and that is just not true, because the vulnerability that allowed me to get this kind of access was in the third-party software. So I really stressed on Twitter that it is indeed caused by a third-party software and the owners using the third-party software, and not by Tesla as a company. Although Tesla as a company could have done steps that would have prevented me from, in the end, being able to control certain features of a Tesla. But in general, Tesla security is great, and I really had to point out that I did not hack Tesla's infrastructure itself.
So, David, you know, here's the concern. If this kind of flaw exists, could there be other flaws? Are you concerned about that Teslas could be hacked in other ways?
that is definitely a very important issue also going forward into the future when cars get connected to the internet more, cars get connected to each other. And cybersecurity is a very important topic. We have to take a look at if we are going to digitalize and connect those cars. And there have been ways to hack Teslas in the past, and I think there will be hacks in the future which affect Teslas and other digitalized cars. So we as a cybersecurity community, as the companies producing those cars and the owners of those cars, we all have to work together to mitigate this and to make sure it's very secure. That is very important going forward.
So, what's the concern here? I mean, I know initially you were talking about 24 cars, but how big could some of these potential problems be? I mean, is this something that could affect an entire fleet?
Well, there's a difference between third-party software and Tesla again. If there is a hack in Tesla's infrastructure, then this definitely can affect the full fleet. And there has been a report, I think, like 5 years ago or something like that, where a security researcher was able to indeed take over the full fleet. But since then, the security on Tesla's side has improved massively. So, but this definitely is a concern that also the full fleet could be affected by a vulnerability. So that's why it's very important to make sure it's secure, or as secure as possible.
David, just really quick, run us through the basics on that second API flaw you discovered with Tesla, the specific one that you hope pays for your coffee. And secondly, you're a young man, 19 years old. What happens next for you?
So the two questions, I will answer the first one first. So the second vulnerability was very interesting because when discovering the issue with the Teslas that I could control certain features of, I had no way to notify the owners. And I really wanted a way to notify the owners. And on Twitter, someone pointed out that there is an API endpoint where I could query the email address of the Tesla owner. And then I went on the search to figure out what API point this is, because Tesla's API is not documented. So I had to search through a few things to figure out that endpoint. And once I was able to figure out that endpoint, I was indeed able to query the email address associated with the Tesla API key, the digital car key. And then I noticed that I was able to query the email address of the Tesla owner using a token, an access token that was already revoked by the Tesla security team. And that's what I reported to them. They already rolled out a fix into production to fix this, because you shouldn't be able to query sensitive information like an email address using an access that is already expired or revoked.
All right, David, we'll be watching for more news from you and to see what's next for you. Thanks so much for sharing your discoveries with us. David Colombo, CEO of Colombo Technology, the man behind the Tesla hack, and our own Ed Ludlow. Thank you both. Coming up, the fate of meme stocks. What comes next as speculative stocks are coming down hard, even as tech stocks are going back in the green? We'll have more on that next. This is Bloomberg. AT&T is rolling out the fastest consumer broadband offered by any of the major internet providers in a move aimed at cable providers. This coming after the company's new 5G service went live last week. AT&T Communications CEO Jeff McElfresh spoke earlier with our Matt Miller. Take a listen.
It's a big day for us at AT&T because we are making progress on our mission to become America's best connectivity provider. And Matt, as you alluded to earlier, as one of the largest, if not the largest, fiber operator in America, we're pleased to announce the availability of multi-gig across our footprint in over 70 metro markets, and speeds that you can get all the way up to 5 gig speeds for our fiber product, which is the fastest that's available. And I tell you that the purpose and why we're doing this is we actually listen to our customers. We tested this service in Raleigh-Durham, North Carolina last year, and the response was overwhelming. For over a year now, we've been building out this network that is multi-gig capable, and today we announced the availability with some very attractive pricing.
All right, so I'm a little confused about the 5G rollout because I was getting 5G cellular service roaming weeks before the hubbub about what happened at the airports. Then we had that. It was a different 5G. What can you tell me about the safety of this network? You know, conspiracy theorists have been up in arms about it for years, and now the airports are worried too.
Well, I know there's a lot of fives in everything we're talking about today in the telecom industry. First of all, the speeds that we're offering on our fiber network, up to 5 gigabits, has no correlation whatsoever to the 5G wireless services that we offer here in the market. And as you pointed out, we've had 5G services turned on for quite some time now.
Jeff McElfresh there, the CEO of AT&T Communications. Meantime, meme stocks took a dive earlier, now bouncing back slightly, but overall losses still piling up for investors who rode the once hot trend of piling into stocks being pumped on social media platforms like Reddit and Twitter. Let's break these market moves down with Bloomberg's Emily Grafeo. Emily, what do you make of the meme stock crash?
Yeah, so GameStop and AMC, two of the original meme stocks, are down over 50% in the last 2 months. Meanwhile, a basket of meme stocks tracked by Bloomberg is down to its lowest level since last January, when the initial meme stock trading frenzy began. But I'm not really surprised by this crash. Meme plays are highly speculative. They're driven by liquidity, and they're driven in large part by retail investors. And every kind of piece of that is taking it on the chin right now as we anticipate the Fed's going to reduce liquidity. We're potentially going to get an interest rate hike as early as March. I had one source, Ross Mayfield from Baird. He told me a retail play on a meme stock is really going to be kind of the first thing to go when we're seeing speculation really start to turn off a little bit.
Right. What does this mean for the retail investor? Are they going to ride the wave or get spooked?
Yeah, it's interesting, and we'll have to wait to see. I mean, it's definitely more fun, Emily, to be a retail trader when you're making a lot of money and you can cheer each other on and you can share your gains on social media. And, you know, people probably have lost real money right now. There's definitely pain within the retail community. I've spoken to a few retail investors who seem to be saying that they're starting to pivot their strategy a little bit now as the speculation kind of comes down. So they're not doing as much day trading anymore. They're perhaps pivoting to looking more at fundamentals of companies and maybe calming down on the in and out options trading, and perhaps getting more into education and not just buying the first stock that you see mentioned on social media.
I was just checking in on the Reddit Wall Street Bets thread. How would you rate this activity compared to what we saw last year this time?
There's definitely a lot less activity on Wall Street Bets. A lot of retail investors maybe not really going to that forum anymore for perhaps advice on what to buy. There are still a lot of Discord groups and a lot of other online communities, though, where we're seeing these retail investors congregate and share strategies and talking. So I really don't anticipate that all of the retail investors who came in during the pandemic and started making money and investing are just going to all of a sudden pull out. So again, I see perhaps a lot of people pivoting strategies. Maybe they're not going to be looking at Wall Street Bets, but maybe they're going to be in an online Discord group that talks about how to read an earnings report, or that talks about, you know, kinds of long-term plays, and people can share that kind of information together.
All right, Bloomberg's Emily Grafeo, thanks for the update. We'll see how the wave is ridden this week. Coming up, China's latest weapon in the tech war with the United States, realigning its country's tech industry, what it means for Silicon Valley. Next, this is Bloomberg. In what could be a transformational showdown for higher education, the U.S. Supreme Court agreed to take up a case that could end the use of race when determining college admissions. The case involves both Harvard and the University of North Carolina, and it's being led by an opponent of affirmative action in admissions. This is the latest threat to a nearly 2-decade-old Supreme Court precedent that let universities consider race to help create a diverse student body. The court is likely to take up the case later this year. And in China, behemoths like Alibaba and Tencent are out of favor, but little giants, or so they're called, are on the rise. That is the designation for a new generation of startups that have been selected under an ambitious government program aimed at fostering a tech industry that can compete with Silicon Valley. Bloomberg's executive editor for Asia Technology, Peter Elstrom, joins us now for more on this week's Big Take. Peter, this is interesting to us given the crackdown on some of these big China tech behemoths, but now the government also wants to support some of the up-and-comers. Explain.
Yeah, that's right. Well, we know that China's technology industry works very differently than Silicon Valley's. And what we wanted to do with this story is take a deep dive into one of these government programs and really look at how it works from the bottom up. So this Little Giants program has been around for a while, but it's taken on new significance over the past year as Beijing has cracked down on the biggest companies, Alibaba, Tencent, Meituan, and Didi in particular. And what we discovered is that Beijing has really accelerated its efforts to build up these little giants, giving money, tax breaks, other kinds of incentives to these companies that are developing technologies that are strategically important. We've talked a few times before about how important the semiconductor industry has been for the U.S.-China relationship, and the U.S. cutting off the best chips from Chinese companies like Huawei has really stiffened Beijing's resolve to build up their own semiconductor industry, AI, robotics, all sorts of technologies like that.
So talk to us about what next, and how will this change the tech industry potentially in China?
Well, the big question, of course, is whether it's going to work. What we've seen in Silicon Valley is that entrepreneurs left to their own tend to come up with the best innovations and tend to build a very robust technology industry. And it's worth pointing out that China's tech industry largely worked that way, too. Jack Ma succeeded because he was given free rein to pursue the vision for Alibaba as an Amazon-like company. You also saw that with Zhang Yimin at ByteDance, who built TikTok. So this is a very different program. This is where the government is helping to kind of pick these winners in areas that they think are important. And it's not at all clear that this is going to win. So we want to watch it closely. We'll certainly track these little giants. They're beginning to go public, too, so they're taking money from public investors. And we'll see whether they can live up to the government's expectations for them.
Should Silicon Valley be worried about the competition or a different kind of competition?
It is a very different kind of competition, and it's certainly a concern that China wants to build competitors in these key areas. So if you're in semiconductors and AI and robotics, you know that not only are China's entrepreneurs coming after you, and we've seen very, very skilled, accomplished entrepreneurs accomplish many important things in the second largest economy in the world, but now they've got this government support too. So they're certainly going to be serious contenders in these areas. We'll see whether they're able to succeed.
All right. Bloomberg's Peter Elstrom joining us from Asia. Thank you for that report. You can check out Bloomberg's Big Take this week. That does it for this edition of Bloomberg Technology. Stay with us all week long. We're going to continue to cover big tech results. Microsoft out Tuesday, Tesla Wednesday, Thursday, Apple and Robinhood. You won't want to miss our coverage. I'm Emily Chang in San Francisco. This is Bloomberg.